Hello and welcome to TS's Finance Nuggets. In today's video, we'll be exploring bonds. A bond is a common investment, but many investors still find it a mystery. So today we'll be exploring how a bond can be beneficial to your portfolio. A bond is basically a loan. Companies or government use bonds to fund new projects or ongoing expenses. Bonds are less riskier when compared to stocks and can be used to diversify your portfolio by an investor, to a company, or the government. By issuing a bond, a company or the government is borrowing money from investors who are in turn paid an interest for the money that they have loaned. Let's look at an example of an hypothetical city, Erville. Erville wants to build a football stadium and has decided to issue a bond of $1,000 to be paid back in 10 years. So to make this bond more attractive, Erville has decided also to pay an interest rate of 2%, which in the bond world is called the coupon rate. So when an investor invests $1,000 in Erville City's bond, it gets $20 every year, and it continues to get this payment for the length of the bond, which is 10 years. So once the bond matures, the investor redeems his bond, and Erville City pays back the principal investment of $1,000 to the investor. This bond is a good deal for both the investor and the city. The city gets to build its stadium, and also the investor gets regular scheduled interest payments and also the return of its principal investment. Bonds are often perceived as a more predictable and more stable form of investment because they offer scheduled interest payments and also return of initial investment or the principal investment. If you compare bonds to stocks, with stocks, the profits and losses are usually driven by market forces, which are less predictable. But like every investment, bonds also has its own risks. One risk that bond investors face is the probability that the issuer will default on paying back the initial investment. But bonds with higher risks usually have higher rates of return. For example, government bonds usually have relatively low yields. The government is perceived to be a more stable issuer when compared to corporate bonds. This brings us to credit rating agencies. Credit rating agencies assign different ratings to different bonds, and this can help serve as a guide to the financial strength of a corporate bond issuer. Also, credit rating agencies measure risks using different criteria, and as such, you should also compare different ratings when considering a bond. The ratings range from AAA, which is high credit quality, to D, which is default. It is also important to note that these credit rating agencies aren't always accurate, and as such, you should also make further research before you invest in bonds. The second risk is interest rate risk. This is the risk that the interest rate in a country will go up, and any bond that you own will be worthless if sold before the maturity date. Typically, when interest rate goes up, investors will be looking to take advantage of investments with higher return and hence want to sell off low interest rate bonds. You'd have to sell off your bonds for a price lower than you bought it for to make it attractive to another investor. Bonds are good for a diversified portfolio, but before you invest in bonds, do make more research and also improve your financial education. Thank you for watching this video, and if you found it useful, give it a thumbs up and also follow at TS's Finance Nuggets. Goodbye.